With merchandising transactions, we also have to keep track of two more accounts. One of them is cost of goods sold, and the other one is merchandise inventory. In merchandise inventory, I keep track of the value of whatever inventory I have in stock. Cost of goods sold is used to calculate the cost, to accumulate the cost of the goods that you sold. So let's try out the first one. Why don't you try this on your own? Purchase store equipment for $3,000 cash. Purchase store equipment for $3,000 cash. What happens to cash? Because cash is going out, so cash, that's an asset going down, is going to be credited for $3,000. What account are you going to debit? Equipment, that's an asset going up, $3,000. All right, next of all, purchase merchandise inventory on account for $9,000. So what happens to cash? I purchased it on account, so I didn't pay anything. There's no cash here. It's a trick question. I tricked you. A sneaky guy. Tricked you. There's no cash. I'm not paying for it yet. I bought it on account. I'll pay for it later. So accounts payable is going to be involved. What do I do with accounts payable? Debit it or credit it? Credit accounts payable because there's a liability, and to increase it, I'm going to credit it for $9,000. The debit goes to a new account, which I'll call merchandise inventory. That's an asset, and debiting it increases it. So what I'm going to do in this account again is I'm going to accumulate the value of all the inventory that I have, 9,000. Then I sell merchandise that costs $3,000 for $5,000 cash. So the first thing that I have here, let's do the sales side of this, the cash side, the $5,000 side. I'm receiving $5,000 in cash, so what happens to the cash account? I'm going to debit cash for $5,000. And the credit goes to sales revenue. For $5,000. Now there's a new entry here. What this entry does is it records that you sold the merchandise. So one journal entry records the sale to the customer. The other journal entry records the sale of the merchandise, which is now being removed from your stocks. So you can visualize it as one side of it is you're getting money from the customer, $5,000. The other side is you're giving the customer the merchandise. So this journal entry would credit merchandise inventory, that being an asset going down because I'm crediting it. And the debit goes to the account cost of goods sold. That's a new account, and it's an expense that's going up. So I'm recording the expense that's associated with the sale. I've got $5,000 in revenues, $3,000 in cost of goods sold. And then the gross profit on this sale was $2,000. So try the same thing now. On August 30th, we sold merchandise that cost $2,000 for $4,000 on account. So that's going to involve, I'll just give you that part of it, that's going to involve accounts receivable. Debit accounts receivable. For how much? For $4,000, because that's the amount of money that they owe us. And what's the credit? To what account? Sales revenue. $4,000. Next, what's the next entry? Debit cost of goods sold. That's an expense going up. For how much? 2,000. And credit what account? Merchandise inventory. You could call it inventory if you want. I like to distinguish it from supplies inventory, so I call it merchandise inventory. That's an asset going down for 2,000. And paid August salaries of 1,500. Just debit wage expense for 1,500. And credit cash for 1,500. How much cash would be reported at the end of the month? See if you can figure that out right now. 22,500. And let's just go over how we got that. Or does everybody? Do you want me to show you how I got that? So that was 10,000 plus 12,000 minus 3,000 plus 5,000 minus 1,500 equals 22,500. Let me make this a little neater. $10,000 plus 12,000 minus 3,000 plus 5,000 minus 1,500 is 22,500. That's how I got that. What would my cost of goods sold be? 9,000. That's just 3,000 plus 2,000 equals not 9,000, 5,000. Sales. Oh, I'm sorry, I read it wrong. Sales is 9,000. Cost of goods sold is 5,000. You are right. 3,000 plus 2,000. What's operating expenses? 1,500. That's the wage expense. So from all of this, what would my gross profit be? 4,000, right? Because it would be, the way I got that, it would be 9,000 minus 5,000. And my net income would be gross profit minus the operating expenses. So my gross profit is 5,000 minus the operating expenses of 1,500, coming to then 4,000. No, 2,500. Questions?